What's up, YouTube? It's Joe Ketchpalia sitting on the couch trying to make some money investing in fractional real estate online as usual. Today I'm going to talk a little bit about a site called Nectar. The website's actually usenectar.com. Um, this was somebody that watched some of the channel had asked some questions about this. Wanted to compare it a little bit to Groundfloor, which is I think um, a pretty good comparison in a lot of ways, and so that's going to be the one that I compare to the most. I wanted to start off though talking a little bit about reminding you what I'm trying to do on the channel. I'm always happy to talk about anything that well, really in real life I'll talk about anything about real estate whatsoever, especially real estate investing. But on here I'm trying to look at any sort of fractional real estate investing that's possible. But in general, I got started looking for a platform that I could send clients to, or would-be clients, people that come to me in my day job, where I only sell real estate investments, but they don't have the capital yet to buy, the deals that I can sell them because whatever, they're just starting off, they don't have a ton of money, and maybe don't even have enough money to house hack or buy a single family home or anything. A lot of the fractional real estate sites that we look at, you can invest for 10, 20, 50, 100, $250, somewhere around there is the entry point for most of them that I've talked about. So the low cost of entry, I think, is really important for that group of people. And I think those are the people who will get the most benefit from me for sharing my real estate investing knowledge, which is, a big part of what I hope the value is of this channel. Um, on top of that, I think some of the other huge benefits to real estate investing, though, or fractional investing, is the ability to diversify, right? Having a very small check that you can put into each one, or a very small cost for each token or share, or whatever the fraction is called on any particular platform, allows you to get into a lot of deals. Versus my whole life or for the last 20 years, I've invested in real estate in real life, and you get a big chunk of money together, you buy one deal. You save up, you get your next amount of money together to buy a deal. Maybe you raise some capital and you buy one. Um, but there's never, until you get to an extremely high net worth, you never have a truly diversified real estate portfolio if you're buying whole properties. One of the reasons that I like looking at real estate, comparing it to stocks, is that when we're looking at little pieces of the real estate, it's really easy to underwrite that real estate, understand what that deal is. That's one of the benefits of a lot of the platforms. There's liquidity, right? On some of them where I might be able to sell my shares right away, where I can't do that with a real piece of real estate. And then you can also, my goal in general and what I'm trying to help do is, take our real estate investing knowledge, point it at some of these platforms, figure out, you know, what are good deals and what aren't, pick and choose from the ones that they provide, and get higher returns for doing so. And I think a good example of that is, looking at Mogul or Lofty. You can look at, okay, what if I bought all of these? What's my average return? But okay, what if we actually stop and look at each deal, pick good deals, and figure out, and actually get above average returns by doing that. That's something I'd like to be able to do. I'm trying to do on most of them. Although I am comparing this one to Groundfloor, and I'm not doing that on Groundfloor, right? On Groundfloor, I am just buying one piece of every single loan that they put out. And I think that for me is the best strategy. And I want to remind everybody, well, please like and subscribe. Oh, I remember that early today, which is great. I almost always forget. But just because I find a platform or property or mortgage or whatever it is to be something that I buy, I show you me buying a lot of different stuff on here, investing in deals, doesn't mean it's the right deal for you. I want you to do your own due diligence. And just because I pass on something also doesn't mean it's the right one for you. And so, with all of those things in mind, I wanted to take a look at this site and figure out, is it one I'm going to put some money in? Is it one that's going to make a lot of sense? And so, what they are, that's like, okay, they're telling you earn 10 to 16% yields backed by low leverage cash flowing real estate. So looking at their site, They do a couple of things. They have a fund, and it's a fund of mezzanine debt and preferred equity. I think if you're not in finance or um, real estate finance or anything like that, you might not know what mezzanine debt is. Preferred equity, I think, is a little bit more of a common term, but both of them are sort of thought of as, somewhere straddling the line between debt and equity. Even though preferred equity is truly equity, mezzanine debt is actually debt. But they both function a little bit of both, and a lot of times mezzanine debt can be converted to equity. Um, so it's sort of there's sort of a spectrum too, and I think we don't really need to get into the weeds of which is which and what's the benefits of either. They're doing both on here, and my guess is state law for wherever the asset is located is going to have some impact on it, and then the entity structure initially that they're what their platform's doing. In general, I think you can think of either of these as being like a home equity loan. So like if you had a first mortgage and you go and take a second mortgage, or, we used to just call these home equity loans, not a line of credit, not a HELOC, but actually just a second mortgage where you're taking out some of your equity. I think it's as a really simplified way, that's a way to think about it. If you want to learn a little bit more, and this is a short blog post. So this site built, it's getbuilt.com, their blog. They're a they're actually a service provider in commercial real estate. I think they do like cloud computing or something like that, but they provide services to lenders and mortgage servicers and whatnot. But I find that their blog is they have really good blog posts on commercial real estate in general. They don't put them out very often, but I find they're relatively high quality. Um, they're really not pushing an agenda with most of them, which makes them different from a lot of blog posts out there. A lot of people are just trying to sell in general. They're just trying to attract anybody that's interested in commercial real estate, and then later they sell to them, right? But I find their blog to be super useful, and they had a good post last year about mezzanine financing and what it is. And it is so. If you look at, and they've got some nice pictures here. If you think of your normal deal, your capital stack, you've got, and what percent it is doesn't really matter, but so, okay, 70% debt, and then you have to bring cash for the 3% equity, right? This is your typical deal. If you have a mezzanine lender in there, it's different, right? You have, okay, maybe you have lower debt, and then you have this second mezzanine debt, or it might be preferred equity in this case, they're doing both. But it's in either situation, it stands between the first mortgage and the equity. Um, and so it looks like that's what Nectar's actually doing. They lend, they lend to, and they talk a little bit about, well, so first off, the number one thing why I think this isn't super applicable to my normal viewer on my channel, or who I think you are at the moment, if you click on their ask more and you put in that you are not an accredited investor, you'll get this, right? In accredited investors, you have a net worth requirement and you have an income requirement. They're not extremely high. I feel like they just haven't been adjusted in a long time, but they are. I think that most of the people that are attracted to fractional real estate today probably don't meet that criteria. I don't remember what it is. I think it's like $200,000 a year in income, or might be $1.5 million net worth. I honestly don't know. You'd have to look up what it is. But if you click that you're not one, they give you this info. If you click that you are one, you have to fill out your information, and then they send you an email or they try to set up a call with you. I always hate I'm looking for a platform where I can just deal with it without having to get a sales pitch. I want to get the information. I want to go through it, and I want to decide for myself, do I like this deal or do I not? It doesn't seem like they operate that way. They did send me their deck. I'm only going to talk about one of the pages in there because I don't know that they want this shared with the whole world, but I think that what their offerings are pretty good. So one of the things I wanted to mention, and that I gathered from so if you do that and you get their investor deck, you can read a little bit more about their strategy. One of the things that they're doing that I think is great is they are doing, they're targeting investors not at, they're not providing this debt to um, owners that are trying to acquire a new property. They're doing it for the most part to people who have bought a property in the past. It's cash flowing. It's commercial property, almost all commercial property, and they said they primarily target multifamily, but they have there's some other stuff they lend on as well. But so they're looking at stuff that it's existing. There's existing cash flow. The cash flow that is already there is servicing the first mortgage, and also it's high enough that it will be able to service the mezzanine debt as well. And so I think it's a pretty good business model. I worked in commercial lending back in 2007 and 2008, and there was a lot of mezz lenders where you could, I mean, there were some really ridiculous ones where you could basically put between 3 and 5% down on a commercial property. Um, I mean, there were just all kinds of crazy deals back then. And that was when I think of mezzanine debt, I just think of this like super risky people entering properties that are way undercapitalized. But that doesn't seem to be what they're doing. And in fact, I do want to show you one other thing they're showing. They're showing like, okay, and they have it flipped upside down. They've got the first mortgage loan, and they're providing a very small piece of mezzanine debt or pref equity. And just so you know, we refer to this as mezz if I've said that a few times. Um, it is just how we think about it. But so they're providing a small chunk of capital. They talk about it as if you need working capital, if you need to do a light renovation. But it's a way that somebody who owns this commercial property who needs some cash can access it without having to do a full refinance and pay off the existing mortgage, which can be really costly. On commercial loans, prepayment penalties are very common. Sometimes you have to pay a yield spread premium or a defeasance. Either of those two can be, sometimes it's just a set like a 3-2-1, penalty, but a lot of times you're doing yield maintenance, which basically is giving the lender uh, their full income, even though you're paying off early, or you do defeasance, which is like you have to go and buy treasury bills and so many so that the interest from those can pay back the mortgage. I mean, both of which are very expensive options. And so in general, a lot of times people with can't refinance that commercial mortgage. And so getting to tap into a second mortgage or some preferred equity, to do something that they need to do, I think it's a useful product. I think it's especially useful today in a world where people have low interest rates. And even if they could afford to refinance, maybe just don't want to for a reason, for one reason or other, because they don't want to get the higher rate. Um, they have one of the things when I was looking at their deals on here, it's the details, and anything you click on, they want to have you do that. I really don't like that, right? I'm looking for platforms where I can just get in, I can invest. I'm not looking to um, tie that up. You can see on here, they do tell you, what your yield you just expect to get, your minimum payment, and this is what one of the things, what I'm saying. This is not a low cost of entry product. Actually, though, if you look in their deck, like I was on the right page earlier, it seems like they have this other product where you could put a smaller minimum investment of 25,000. I didn't see that actually on their site anywhere. Um, but it is in the deck that they provided. But what they're saying here is what I think they're saying is that you're okay. So there's three options that you can do. You can do their Nectar fund, which is they take a group of these mezzanine loans that they've put together and they put and it's a fund, and so you're getting it's the funds, a lot of what if you're not familiar with this, it's very similar to like how a REIT works, although it may not be an actual REIT. But it is one entity that holds all of those individual either mezz or pref positions within the entity. You get paid out, and this one you can see they're giving you a lower annual return for owning that. Um, that's again, but for all of these, you have to be accredited. So if that's not you, or if you don't want to make the big payment, it's not a very useful thing. But even beyond that, I think if you are in that situation, but would you want to do it, right? If you're looking at this Nectar Fund 2 and you're comparing it to Groundfloor, um, and so I've chosen not to do any of these, at least not and talk about them on the channel because like I said, I mean, I don't think that they are particularly fitting. But if I wanted to compare this to Groundfloor, it's not really like investing in the individual LROs. It's much more like if I wanted to compare it to the flywheel portfolio. Um, One of the things, both of them are investing in mortgages, but, if you're talking about the flywheel portfolio, you're talking about investing in just the first mortgages, right? Whereas here, you're in this second position, and so in general, a second position is going to be riskier than the first, right? I mean, because if things go wrong, there's less protecting you, right? You could lose this. Although if you're at that same lower loan to value, it may not be, right, where they have a very low first on there. Um, so there's that. The nature of these loans are longer term. I want to say the typical one that they do is 5 years is what it looked like. Where with the flywheel portfolio, well, the loans in there are all, tend to be about 18 months or less. And so, you end up having less, less of that risk of having your money get locked up at a lower rate and then the rates go up. But you're on the opposite of that is true as well, right? Um, so I think the overall position, right? The fact that you're in second position makes it a little bit riskier. These funds, it looked like at least the info they put out 2 years ago, they had only invested in 90 something properties. If they that was their first fund and this is their second one, you're not getting as much diversification, right? And that's another thing we were looking for. Like that flywheel portfolio, it looks like it was 250 plus mortgages in there. Where it's not really clear how many loans are going to be in it. And I don't know if you remember, but when I was comparing investing in the flywheel portfolio to investing in individual LROs, that video is in my, it's in that ground floor playlist that I have on the channel. Um, I prefer to pick the individual LROs versus the portfolio. One, because once you have the fund, then you have fund level expenses, where you don't necessarily have that when you buy the individual notes. Um, and that's comparing here. And then the other thing is, so I think you get much wider diversification with the flywheel portfolio than you get with this. You're getting it is fix and flip loans though, which is not, which makes that riskier than loans that are underwritten based on in-place cash flow, right? So I think there's some trade-offs. I could see, especially if I could get behind the individual assets they're picking, which, I don't know how much you get to find out about the individual assets in each fund before you invest in it. And I think probably sometimes they're raising those funds before they're, giving out the money. And so I think that would be problematic for me, because one of the things, like I said, I want to know that I can, use my real estate knowledge, pick and choose deals, and hopefully get a little bit better than the average return. So, that's for that reason, that's not really for me. Again, could be for you. Um, their Nectar notes, this is more like investing in the individual notes on ground floor, but the difference being, again, you still have that difference in the first mortgage versus mezz debt or pref, and you have the difference of, these are commercial properties versus single family homes. Um, the lockup time period, right? These are less than 5 years, but varies by note. This is, you're locked up in this for a full, 12 full calendar quarters, which is interesting. Perpetual lockup of 12 full calendar quarters. Yeah. So it's a weird way to put it, but so that seems like 3 years to me, right? Uh, where, so the fund is perpetual, but the lockup is for that period of time. Where like if you're buying the individual LROs, like which are pieces of the individual notes on ground floor, I've had 8 pay off out of the 100 that I bought already. Um, and and you'd expect all of them to pay off in around between 12 and 18 months, so you get all your money back that way. And also in their flywheel portfolio, I believe you can have it so it's paying back, it buys the initial portfolio, but it pays you back the interest and pays out um, the the principal back over a short period of time too. So I think that you have a little bit more liquidity with ground floor than with this, but it's I think it's I don't know that that makes it a huge difference for me. Um, with their subordinate promissory note, what I think they're doing here is saying, okay, we do this capital stack. There's this first mortgage. Nectar's coming in. We're doing our second mortgage out of one of our funds, and we're letting you come in with a third mortgage, but ahead of the equity. That's what this looks like to me. Um, when they're saying subordinate to the senior credit facility, to provide mezzanine debt and preferred equity. I'm not positive. I don't know if this is really what they're doing. This one seems like you're just owning a piece of theirs, and this one seems like you have one of your own. But I'm not sure. You know, if I were going to really get into this, I'd want to get on the phone with them, ask them those questions, right? What's the difference here? Why is this smaller? What's going on? I mean, it's not super clear from anything that I read about it. Um, if I were really interested in, uh, I've always been a big fan of mezz debt and preferred equity. I think you're typically getting pretty solid returns, and I mean you can see they've got pretty good returns, but you're getting a little bit. You're getting security that's closer to a lender level. First or it's not first mortgage, but you're getting closer to that type of protection, especially on something like this where they have really low LTVs on the first mortgages. So I think it's interesting from that perspective. Um, if I had millions of dollars that were liquid that I needed to put to work today, um, might I make a check, put 100,000 or a couple hundred to this? I think that it is, it's a way to diversify away from the residential stuff. It's a way to, but I think that's not most of us right now. It's not. I wouldn't put a large portion of my net worth into the fund or into any individual note. Um, I'd want, and that's one of the things that I really like about Ground Floor. Like I have 100 notes on there. I've only been buying notes for I don't know 5 or 6 months at this point. Or I have 90 92 left. I don't know. Maybe I have. I don't remember, but it's somewhere around there, right? I had maybe I bought 90 and I have 82 left. I don't exactly know, but it's a lot, right? It's close to 100. It didn't take very long. I haven't even bought every single one that came out, right? And so I'm getting very wide diversification. I like that. I like that several of them have paid off already, but I also like that I truly understand the asset itself, right? Like that's one of the tough things is if I'm looking at any, if I am going to invest in individual notes. Uh-oh, what happened there? If I were going to, invest in individual notes with them, I'd have to really be comfortable underwriting that deal, right? If I'm going to put 100K, that's basically just cash in one apartment complex in one market. Um, I'd really only want. So now that I have the option to get true diversification in real estate investing, uh, on picking individual properties, like it's tough for me to want to. I'd want to have enough cash where I could buy a whole bunch of these, right? Not just invest in one for sure. And, for the reasons that I don't really like, private REITs is the same type of reason that I don't really like funds. And, I did another video about that when I talked about roots, investinroots.com, I think it is. But when I did a video on that and talking about like why I think private REITs, um, why they're why they don't fit for my specific investing criteria. But the one of the main one, or several of them, right? I mean, there's you have the fund level or the REIT level expenses. I grew up, my initial jobs in real estate were working for large public REITs, and there is definitely a lot of wasted expense when you look at REIT operations, and then you don't get to kick out any of the deals that you don't like, right? You end up just having all their deals. And so for me, that's just not the strategy that I'm going for. I think it's if you're looking for a more passive vehicle, I think it's could be perfectly appropriate. Um, yeah, I think that. So I think going back to, if this is I think those are all the main points as far as I'll just summarize versus ground floor, right? We have a commercial position versus residential, although these are it's residential, but in the real estate world, if it's a residential property greater than 5 units, we classify that as commercial. That might have been confusing to some people if you didn't know that. um, it's okay. You have residential properties versus commercial. Residential properties tend to be a lot more liquid, right? You can sell homes a lot faster and more often than you can sell large multifamily properties. Although in this world, the time has it's a little bit closer, but it's still true. Um, you have first mortgages with ground floor versus a mezzanine or preferred equity position on Nectar. You have, which I think favors ground floor, but then on the flip side of it, you have fix and flip loans with ground floor, where on Nectar, they're just accessing some equity and making payments with cash flow that they already have in place. That's something I really like about them. Um, on both platforms, you have the two options, right? You have the fund option, which is the Nectar fund versus the Flywheel portfolio, or you have the ability to invest in individual notes, which is, sorry about that. I just had some technical difficulties. As I mentioned, both platforms, you have the fund option, and then you also have a note option. And it looks like on Nectar, you might have two note options. You might be able to have a piece of one of theirs, and then also have an option to have just a subordinate note. It's not completely clear to me that's what's going on. You'd want to dig into that if you chose to go this direction. Um, so I don't know. I think that there's, it's a pretty good trade-off between the two. If you wanted to put this much capital, excuse me, to work on one platform. For me, I'm really looking for the diversification of platform risk as well, right? So I'm not trying to pick the one right platform. I'm trying to spread capital across several. And also, if you've been watching what I've been doing, I've been really just experimenting with all these sites at the moment. So I'm not putting a whole bunch of capital to work on any of them. And so, you know, that type of dabbling is something that I can't do with a bunch of these, right? I couldn't write $100,000 checks to you know any large number of these and feel good about it, right? And have a situation where um, I'm not putting a bigger piece of my net worth at risk than I would want to, just to try out one site or another, right? So if I were going to do one of these, honestly, I would probably talk to some of my good, I worked in commercial real estate for a long time, talk to some friends, figure out whose funds I should invest in, because I actually know quite a few people who run funds, and wouldn't mind. And if I were going to do something like this, I'd probably choose to invest in someone's fund who I knew and trusted. Um, not to say that their funded ed would be any better than this, but I think when you're writing larger checks, you really want to be comfortable with who they are, right? And one of the things, I don't know how you came across Nectar, who the person who recommended this. One of the things that is, a lot of the funds that are out doing doing fundraising most aggressively are doing it because they're not just attracting money on the strength of their deals from people in the industry, right? Like, I mean, there is commercial real estate is a very deep pocketed industry. There's a lot of big players as far as like hedge funds and um, retirement funds and all sorts of different groups that regularly invest in in the commercial real estate funds that are out there. And so if they're not able to attract institutional quality money, um, you want to understand why that might be, right? Why they have a platform trying to attract investors online when it is not. They're not trying to cater to retail investors that are just trying to put small amounts of money at work. So like they're sort of in this world where they're targeting accredited investors, and so they're looking for large enough amounts of capital that I would expect them to be able to go to some, relatively savvy investors and not necessarily have to, uh, you know, I hate to hold it against them, but I mean, using the internet to raise money these days is, and having to, having this thing where like, okay, right away schedule a call with me, and I'm going to try to sell you on stuff. I think that is, um, it reminds me of like sort of the Grant Cardone model, right? Like that guy is fantastic at raising capital, but not necessarily the best at choosing properties or executing on a business plan, right? Like I think most of the time, some of the most aggressive capital raisers are out there are good at raising capital and not necessarily good at getting a return on it. Now, that's not to say that's really what's going on here, because honestly, this business model is one that I like. I think, like I said, I mean, I'm a big fan of Mezz doing it in this way where it's not acquisition Mezz. They're doing it to, let owners take out some capital. I think if you have if you're doing that with prudent underwriting, um, it could be great if you're getting people to pay you the types of returns that they're getting, right? So I'm not necessarily saying there's anything particularly wrong with them. It's just if I were going to invest on this level, um, I'd want to just go to industry players that I know and trust. Um, yeah, and I guess that's really all I have to say about that. Uh, it's not one that I'm going to be experimenting online. You're going to have to, it's something just like all the others, something you want to do your own due diligence on. But it is. I would never, if any of this size is a significant portion of your investment capital, I'd be really hesitant to do it, right? Like I'd want to, um, for me, like when I was buying, what I'd like, I don't want something to be 5% of my net worth, right? Like any individual investment. Or it's one of the things early on in real estate, buying real estate deals, that you just can't help it, and it is one of those things where I guess I'm saying if it's an investment I don't control, right? Because I mean I've done it lots of times early on, especially like my first investment property was basically my entire net worth at the time, and the same was true with my second, and for quite a while. I mean it ended up being very big chunks, but having but those were things that I had complete control over. Having an investment that you're handing off to somebody else, because I think you have that added risk of, uh, just the lack of control. I just don't want to put a ton of, any large percentage of my net worth into it. And so I don't know. I'd be really hesitant, but I think that's really all I want to say about it. I think that in general, I've made all the points that I would like, and now I've been rambling for a couple of minutes, and I'm sorry about that. I'm going to try to tighten these videos up a little bit. I would really suggest, if this is a new concept for you, go back and read this article. Um, and if you do have questions, I mean, it is like this type of lending, and is something I have, a decent amount of experience with. Um, as working in commercial mortgage brokerage, I didn't work for an actual mezz lender at the time, but worked, through several life insurance companies, and who else did it? And some hedge funds that would do this sort of lending, and then just sort of, just non-bank lenders, basically. Um, so yeah, if there's specific questions you have about that, I'm happy to talk about it. I know this is kind of taking us pretty far away from my typical topic, It is technically fractional real estate investing. It's just not necessarily geared towards who I think the most likely user or viewer of my channel is. But maybe I'm wrong. I think that it is. And we're talking about Nectar, of course, not not built. That's just that blog post. Um, I think that's really it. I think that now we're done, and I'm sorry. I've stolen 2 more minutes of your life with additional rambling of me apologizing for rambling, and so definitely now, until next time, I am going to just keep making mistakes so that you don't have to.